Sounds like a dream, right? The chances that you will get the best stocks is low. They are market leaders. They have huge market share, getting good returns, but at a low risk. When the market touched 3,000, there was jubilation, there was clapping of hands. Probably one of the best inventions, I would say, in the financial market. 5 good reasons to invest in large caps. Just imagine you want to start a business, but there are conditions. You don't have the expertise, you don't have any expertise. You don't want to start from scratch. You want to invest in an established business. You just have to put your money. That's a business which is growing business. And you don't want to invest in small businesses. You want to invest in businesses which are big. Right? The conditions are you don't start from the scratch. You don't have any expertise. And the third is you don't want to put lakhs of rupees. You just want to put thousands or hundreds in this business. Sounds like a dream, right? Sounds like a crazy thought. But friends, the truth is that you can invest. You can invest in businesses that are big, that are profiting, that are established. You don't have to learn anything about the business. You don't have to start from scratch. You can invest as little as probably 100 or 500 or 1,000. And that is the truth. And that is called the equities market. Yes, friends, this video will be about equities and in particular, large cap equities, right? So before we move on to large cap and, the mid caps and small caps, let's talk about equities. Yes, friends, equities. Equities or the stock market is the only opportunity, is the only way where you can invest like this. One of the best ways to invest, and that is the stock market. And stock market is a place where you can buy businesses and you can sell businesses at just a very small amount. Probably one of the best inventions, I would say, in the financial market, and which has transformed lives, which has changed lives, which has made people wealthy, which has given so much. It has made people wealthy. It has made people knowledgeable, and stock markets are really the indicator of an economy. And right now, we are at the top of the stock market, whether it is Bombay Stock Exchange, the BSE Sensitive Index, or the NSE, the Nifty 50. We are at the top. Things are looking very good. But that doesn't mean that they will always look good. But the fact of the matter is, the prices will only keep going up. The stock market will keep going up. Yes, there'll be ups and downs. When I entered the industry, the stock market, the index was less than 3,000. I still remember the day when the market touched 3,000. That is in 93. Once again, it had already touched. It came back with Harshad Mehta scam in 1992. I joined the industry in 1993. And once again, when the market touched 3,000, there was jubilation, there was clapping of hands. And today, this market is at 80,000. In 1993, when I joined the industry, the market was around 2,300. And today it is 80,000. In last 31 years, it has given a compounded return of 12.09%, which means 1 lakh would become nearly 35 lakhs. 1 lakh would have become 35 lakhs. That is 35x. Remember, in my previous videos, I've talked about asset allocation And I said that equities are the engine for your growth, engine for the growth of your portfolio. So it's a no-brainer that you must have equities in your portfolio, because equities, what returns equities have given and can give, the potential to give, no one can match. When you compare it with debt or gold or real estate or commodities or any investments. Yes, there are venture capital, and then, you know, there are other ways of investing which are very risky, like alternatives. But we are not talking about that. We're talking about salaried class, people like you and me, who have to invest, who have to grow their wealth slowly. So equities must form a part of your portfolio. So in equities are very vast. Equities market is very vast. There are thousands of companies, and there are different classifications like large cap and mid cap and small cap and micro cap. So there is a lot of categorization. But in this video, we will talk about large caps. What are large caps? Why are they called as large caps? Which are some of the large cap companies? How can you invest in a large cap? And why it is so important that you must invest in large cap. Uh, in fact, your portfolio must have large caps. And in this video, I'll cover all that. And also, how do you invest? Should you invest directly or through mutual funds? And within mutual funds, should you invest in active or passive? All that I'll try to cover very briefly. I'll try to keep this video short so that you can take some crisp notes from this and think why you should have large caps in your portfolio. My goal, as always, is to help young families grow their wealth and their relationships. So I don't want uh, either of you, like the husband or the wife, just to watch this video and think of making money. No, I want you to think as a team. This is a joint project. Growing your wealth is a joint project because it will strengthen your relationship, your very foundation of your marriage. Why are you married? Right? You're married to stay together. And how to strengthen your marriage? One of the best ways is to become a team in growing your wealth. Consider it as your project. So sit together, understand. And husbands, I want your wife to be empowered. Help her to understand what is it. And I'll try to keep it simple. My videos are basics for beginners. They are not complex. I want you to understand it along with your spouse so that together you can build your wealth and you can be of great use to this society. Right? So let's get into this video and we'll try to cover as much as possible. And the goal is to help you understand this, increase your financial literacy so that you can invest in the right products and grow your wealth. Let's get into this video. So let's briefly understand why we must have equities in our portfolio. I've explained this in fairly details in my other videos, like the video on confused where to start investing, and wealth creation is boring. And I've also talked about in my other videos on asset allocation why equities is important. And also my video on announcing the best mutual fund not for you. There also have explained in detail why you should invest in equities. Equities, again, let me emphasize, it is the engine for the growth of your portfolio, for your investments. And before investing, obviously, you should find out what is your risk profile and what is your time horizon, which depends on your financial goals. So I've explained that in my video uh, on mutual fund, on choosing the best mutual fund. So please watch that. And then when you come and watch this, this will make a lot of sense for you. So why you must have equities in your portfolio? However your risk profile is, even if you have low risk profile, why you should have equities in your portfolio, and why you should have more than 5 years, 5 years, 10 years, 20 years. Let's take a look at some of the numbers, the data that is there on the internet. Now, if you look at this data, which is from 1998 to 2018, again, long term, equities is for long term, not for 1 or 2 years, but long term because of high volatility. If you see here, uh, equities has given 13%. The next best is gold and then FD and real estate. So 13%, which means if 1 lakh, if you had invested in 1998 in the index, which is the least volatile compared to stocks, individual stocks and mutual funds, it would have become 11.52, means 11 and a half times X returns. Gold would have given you 8 lakhs. This is for 20 years. Of course, the volatility is very high. It goes up and down, but it still keeps going up. Compared to gold, gold is not so volatile, but also gold is negatively correlated. So I've explained in my video on asset allocation why you should also have a small percentage of gold. But when you look at only equities, why you should have a large portion in equities, it is because of this. So if you're a young man in your 30s, at least 70% or 80% should be in equities. If you are a 40-year-old man, 100 minus your age, or old 40-year-old man or a woman, 40 years means 100 minus 40, 60. So 60% roughly should be into equities. Of course, this is just a rule of thumb. I've explained clearly what should be your asset allocation depending on your financial goals and your risk profile. So it's never a good idea to have from 1980 to 2000. If you see, the markets have fallen here. 2002, the market has fallen here. It is only in 2006 it has gone. Again, it has fallen in 2008 and 2010. So equities is not for short term, but for long term. Because your financial goals, your retirement, your children's higher studies, their marriage is all much, much later in life, 10, 15, 20 years later. So there is nothing better than equity. Let's look at another chart. This is from 1998 to 2000, that is 10 years. What it shows? Again, equities. If 1 lakh in equities would have given you 3.8 lakhs, and the second best is real estate, 3.42 lakhs. This is when you're making the shorter period. Again, equities is the winner. And in the third, this is from Morgan Stanley. They did a research. They have produced this data where it shows that in the last 20 years, if you had invested 1 lakh 20 years ago, it would be 11.32 lakhs as of 2015. Gold would have given you 5 lakhs. Now, I don't have exact numbers 2024. Probably I'll do some research. I'll find out and share it with you. But right now, this is what it shows. So even if it is from 2015, 15 years back, if you see, again, equities is the winner. 10 years back, again, equities is the winner. 5 years back, it is equities is the winner. In fact, 2024, if you go back 5 years, the index has given 15 to 17% returns. So if you had invested just in the index, Nifty 50, you would have got 16% as compounded returns, which means if you had invested 1 lakh, you would have got 2 lakhs 10,000. But if you had invested in a mutual fund, a large cap, something like an index, which has stocks from the index, you would have got roughly 2.5 lakhs. So in the last 5 years, the markets have done superb. They've done really well. So that is what equities have given compared to any other asset class. So this is the reason why you should have equities in your portfolio. First, find out what are your financial goals. Then what is your risk profile? Your risk profile could be conservative, moderate, or aggressive. Even if it is conservative, that means you are scared about your investments. You can't take too much risk. Equities, you should have a small portion because that is the engine. Again, I repeat, again, the engine for the growth of your portfolio. Right. So this is about largely about equities. And as I'd mentioned earlier, equities have large caps, mid caps, and small caps. And what are large caps, mid caps, and small caps? We'll see that in a little while, and we'll focus on the large cap. So this video is about large caps. So try and understand the importance of large caps and why you should have large caps. So what are really large cap companies? Let's take a look at the definition of large cap companies and what are some of the famous companies that are a part of this large cap. So the definition of large cap companies, according to our regulator, is large cap companies are the top 100 companies listed on the stock market based on their market capitalization, which is usually big, like more than 20,000 crores. They're also known as blue chip stocks. So these are large companies, big companies where you can invest with a small amount. Just see the size of these companies, and you get a share, a small share from this company. What is market capitalization? Market capitalization means the market price multiplied by the outstanding shares. So basically, every company has equity shares, which means you can take it as a big company which has got uh, lots of equity shares, lots of shares, each divided into rupees 10 or rupees 100. And these are sold in the market. So these are the outstanding shares, which means this whole company is owned by the Reliance Industries promoters, like Ambani, Mukesh Ambani, and the others. They have a big share. And then a lot of the share is given in the markets, is actually is in the market. So in the stock exchange, when you go to the stock exchange, BSE or NSE, you can buy and sell Reliance. So all these outstanding shares, which run into lakhs, multiplied by their price. So roughly around 2,900 to 3,000 is the share price. So 2,900 multiplied by the outstanding shares gives the market capitalization. So that is market capitalization. So let's take a look at example of a company of Reliance Industries, which forms a part of the index of the large caps. So Reliance Industries has a market capitalization of around 20 lakh crores. Just see the number of zeros as on 2nd August, which means the market price of Reliance multiplied by the outstanding shares of Reliance is equal to 20 lakh 28,000 crores. Such big is the company. And if you invest in Reliance, even one share, you become a co-owner. You've got a small part of this equity, those number of shares which are outstanding. And this is the market capitalization. So just like Reliance, which is a large cap company, there are many other companies. That is, there are around 100 companies. To name a few, HDFC Bank, SBI Bank, ICICI Bank, Bharati Airtel, Life Insurance Corporation, Hindustan Unilever, Titan, and TCS, Tata Consultancy Services, Infosys, Tata Motors. So there are some of these companies which are large companies, which are a part of the large cap index. Why you should invest in large cap equities? What's the reason? Are there any good reasons? Yes, there are 5 good reasons to invest in large caps. What are those? So number 1, why you should invest in large cap equities. They're called the blue chip companies. And so they have a blue chip stability. Remember, these are large companies. They have a very strong balance sheet and they have been operating for a number of years. So they are big companies, large size, profitable companies, especially all these large cap companies. Most of them are profitable companies. So they are very stable. Can you imagine Reliance Industries or HDFC Bank? Somebody tells you that, hey, tomorrow or within a week, this company may close down. Can you believe? You can't believe. All these big companies like Indian Oil Corporation or Coal India, these are all the public sector companies. And Infosys, Wipro, HCL Technologies, Bharati Airtel. Tata Motors, these are all large cap equities. If somebody tells you, hey, this company can close down within a week or a month's time, would you believe? No. We cannot believe because they are strong companies, stable companies, reputed companies with high credibility. And the good thing about these companies are they are stable. Whenever we look at equities, we are, by the way, we are now here looking at equities. We are not comparing equities with anything else. We're just comparing equities as and large caps as a category within the equities. And now, if you compare large caps with mid caps or small caps, which I will talk about in a later video, you can always watch them on YouTube. There are a lot of videos you can watch. What are mid caps and small caps? So, mid caps and small caps are smaller companies. So, they are less stable. They can close down, especially the small companies. Mid companies can, you know, can get affected. So the volatility is high. When the markets, when there is some negative reasons, there are negative news, mid caps and small caps fall down, they fall and they crash much large percentage. But large caps do not. For example, if the market falls by 5%, small caps, mid caps can fall even 10-15%. How that is the way that volatile those companies are. But large cap companies are stable. So if you have large cap in your portfolio, if the market is volatile, the volatility will be less. It's like you know traveling. It's like traveling in a Mercedes. Strong, stable car, strong, strong and stable car. What happens? The shaking inside the car is less. But if you're traveling by an auto, how much will you shake? Can you drink a glass of water in the auto? With great difficulty. The glass will be shaking, the water will be, spilling out. But if you are in a Mercedes or on a Volvo bus, smooth, they are stable. What happens? You can drink your glass of water very easily. Same way, the volatility, the shakiness is very less in blue chip companies. So that is the number one reason why you must have in your portfolio. Number two, they give you very good returns with low risk. Now, as I mentioned, in the last 1 year, the large cap index has given 16%. But there are some companies which have given 50, 60, 80% also. But over a long period, if you see 5, 10 years, they've given very good returns. But they are less risky compared to small caps and mid caps. You get very good returns and you have to take very low risk. So at a very low risk, you get high returns. Let me share with you let me share a chart which shows how less risky are large caps compared to small caps and mid caps. Now look at this chart which talks about. So here, if you see, let's see from 2013, large caps have given 9%. Same time, mid caps have given minus 5.7, small caps minus 11.2. 2014, large caps have given 29%. Mid caps, yes, they've given much higher percentage. But if you see, here also positive, here also positive, whereas mid cap and small caps were negative. This is the only year you see large cap has given negative returns, whereas mid caps and small caps have given positive. Now, again, if you see here, mid caps 8%, large caps 1.9, small caps 1.8. Again, there is positive. Here, if you see large caps is positive, yes, mid caps and small caps are also positive. Here, large caps 5.9, very good returns. But if you see mid caps and small caps, minus. Here again, large caps is 14.4, mid caps and small caps negative. Again, 2020, yes, small caps have given good returns. Large caps also have given competitive returns. Again, large caps have given 22%, mid caps, small caps, mid caps. But here, again, mid caps, very less, small caps, minus, but large caps have given positive. Here, Large caps have given positive, small caps and mid caps positive. But if you see, large caps have given in this overall, large caps have given positive. Only 1 year in 10 years, they have given negative. Small caps and mid caps have given negative a number of times. For example, once, here, twice, thrice, they have given negative returns. So if you see, they are stable and also they are less risky compared to mid cap and small caps. So on a calendar year basis, you see that you are getting good returns, but at a low risk. Now, this is also another big reason why you should invest in large cap equities. They give dividends regularly and large dividends. Let's take a look at four companies I've taken here. If you see here, these four companies, they're large cap companies. Indian Oil Corporation. It has given a dividend per share, rupees 15, annual dividend, which turns out to be 8.8% yield, which means this divided by the market value, market price today, it gives you. That means it is given around 9%. If you had held 100 shares, you would have got rupees 1500 as dividend. Mind you, as I said, they are stable companies. They give you good returns at low risk. And here you have got 80% appreciation returns in 1 year. That means it's 80 plus 8.8. And this 8.8 is on the current market price. If you look at last year's market price, you would have got nearly 96 to 100% returns. Same here, Vedanta, 26, and you got a yield of 6.16. You would have got 2,600 rupees as dividend, 81% capital appreciation. Coal India, you would have got 5.63 yield. You would have got a dividend of around nearly 3,000 and 129% capital appreciation. HCL Tech, 4.03, 6,400, 36%. Now, mind you, just a caveat here, this is only last 1 year. Okay, this is past performance. This does not mean that it will show the same performance next coming years, right? So last 3-4 years, our markets have done really well, exceptionally well, especially in the last 1 or 2 years. So we have seen such returns. But even when the markets are down or markets are low, you still see that these companies pay dividend year on year because their dividend is not depending on the market price. Their dividend is depending on the profits they make per year. So this is one of the big reasons why you need to invest in large cap companies. So they are market leaders in their space. They have a huge market share in the country in those products. For example, Hindustan Unilever. It is a market leader in India. It has got 50 products and 8 out of 10 household use their product and their market share is around 40% in India. So they are leaders. When you are investing in a large cap stock like this, you are investing in the leader. So look at some of the common brands. I'm sure you're using a number of these products. Surf Excel, Brook Bond, Lifebuoy, Glow and Lovely, Dove, Ponds, Lux, Wheel, Vim, Rin, Horlicks, Lakme, Clinic Plus, Close-Up, Pierce, Comfort, Quality Walls, Brew, Kisan. I'm sure you're using 50% of these products. I'm surely using a number of these products. So they are market leaders. They have a huge market share, around 40% market share. Why wouldn't you invest in this? Tata Motors has 14% market share. And it is the number three in the in ranking. It comes after Maruti Suzuki and Hyundai. Tata Motors are the best selling cars in our country. And when you invest in Tata Motors, you are investing in a large cap company which is a market leader. Indian Oil Corporation, around 45% of market share. And when you invest in a large cap company like Indian Oil, you are investing in a market leader. Wouldn't you want to invest? Wouldn't you want to have a large cap in your portfolio? I would certainly want to have, and I do have. If you do not have, you're missing huge opportunity, huge profits, returns for yourself through which your wealth can be built. Finally, large cap companies operate globally. They have a global reach. Again, coming back to Hindustan Unilever, it operates in 190 countries. Tata Motors operates in 170 countries. TCS, 46 countries. Another large cap company called Sun Pharmaceuticals. It operates out of 100 countries. Reliance Industries operates out of 100 countries. Infosys, 56 countries. They have a global reach. Tell me, why would you not invest in a large cap company when you have all these five advantages? They are blue chip stability. They are stable companies. They won't close down very soon, immediate. They are large companies. They will survive for many years. Then we saw they give good returns with low risk because they give positive returns, little less than, probably less than, they give less than mid caps and small caps, but you take less risk. The drawdown is less. Drawdown means from your top portfolio, your market value, it doesn't come down too much. Whereas mid caps and small caps can come down a lot. So you are safe. Number three, they're dividend giving companies. You saw some of those companies I shared, they give dividends. Dividends are like interests. So you are receiving dividend plus capital appreciation. So just imagine, why would you not invest? Number four, they are market leaders. They have huge market share because they are big companies and they have global reach. Now, with these five reasons, wouldn't you want to invest in a large cap company? It's a no-brainer. You must invest. I hope after watching this, you are inspired to invest. Now, the question you may be having here is, how do I invest? How many ways are there to invest? Yes, they're all available in the stock market, but there are two ways to invest. One is you directly purchase from the stock market, and second is you buy through mutual funds. Now, if your risk profile is high, aggressive, or moderate, you may buy directly from the stock market. But if your risk profile is low, you have never invested in equities, never invested in mutual funds, please do not do it directly. Please do it through mutual funds. In a little bit, in a little while from now, I will talk about how to invest in mutual funds and why you should invest in mutual funds. Let's take a look at how to invest and what are the advantages, benefits of investing directly, and what are the disadvantages. So let's take a look at what are the benefits and challenges investing directly. Now, what are the benefits of investing directly? There are number of benefits. Number one, high returns compared to the benchmark index and mutual funds. Very high returns. For example, Mahindra and Mahindra in the last 3 years has given a returns compared to the June 2024 prices. Going back 3 years, it has given 54% compounded annualized returns. That means a lakh rupees would have become 3.65 lakhs in 3 years only. It is more than tripled. In fact, BSC index, that is BSC Sensex, returns was 14% compounded. That means a lakh would have become 1.5 lakh. And a top rated mutual funds returns in the same period would have been 20% CAGR compounded, 1.73 lakh. So if you compare Mahindra and Mahindra's returns, it is way more than a mutual fund or an index. Four stocks in the 30 stocks in the BSE Sensex, four stocks gave 40%, above 40%, up to 54%, including Mahindra and Mahindra, NTPC, Bharati Airtel, and Tata Motors. Huge returns. So if you had invested in these four or five stocks, you would have got real high returns. Your money, 1 lakh, would have become 3 lakhs and 4 lakhs. Just imagine the returns you would have got. So 11 stocks gave returns ranging from 16 to 36%, way above the average returns. Now, what are the challenges? The challenges are that 50% of these 30 stocks returns were less than benchmark BSC index. That means less than 14%. Five stocks gave returns ranging from 10 to 14% compared to the benchmark 14%. That means these five stocks, three stocks gave returns ranging from 6 to 10%. Four stocks gave 2 to 5%, and three stocks gave negative returns, which means, so out of those negative returns are Infosys, Asian Paints, and Wipro. They gave negative returns in the last 3 years. So if you had picked any one stock from these 30 stocks, the probability that you would have got positive returns is 50%. Positive returns in the sense compared with the index. 50% would have given. So the problem is that if you had picked any of the low returning stocks, you would have got low returns, including negative returns. And by the way, I had Asian Paints, Wipro, and Infosys in the last 3 years. Wipro for a very short period, but Infosys and Asian Paints were there in my portfolio for 3 years. So I have got negative returns. But the good thing is that I also had other stocks like Tata Motors, Titan, and other stocks which gave me positive returns on the portfolios where I directly picked. So you see the challenges. So what does this mean when you look at the benefits and the challenges? The challenges outweigh the benefits because the chances that you will get the best stocks is low. And to pick the best stocks, you need to research. You need to actually study the financials, understand understand the returns, understand the fundamentals of the company. Once you understand, then you take a chance. Even there, you can go wrong because you don't know what is going to happen in the future. It may look good, that is the past performance, but what about the future? So you just don't know. So you can make mistakes. So although large cap stocks should be a preferred stocks, but you can still make mistakes and you can land up into negative returns too, or subpar returns. So what are the benefits and challenges investing in mutual funds? The benefits. Historically, top-rated mutual funds have given returns much more than the benchmark. And I'll show you some of the numbers where mutual funds in the last 3 to 5 years, what are the kind of returns they've given compared to the benchmark. They're managed by professionals. The fund managers are experts. They've got 10, 15, 20, or 25 years of experience, and they have got a big research team which works for them. And these research teams, research analysts, research every company, their financials, their potential, future potential. In fact, fund managers even visit those companies. So they have a lot of insights which you and I don't have. They can find out, and sometimes these are not available publicly because they go and meet them, talk to them. Although the data becomes public, but the insights that they get from the management is very precious. So they're managed by professionals. So you don't need to do any research or reading of financials. You don't spend your time, right? If you just do a SIP in a diversified mutual fund, and that can give you phenomenal returns without really spending even a minute. Just invest and just forget it. You can watch my video. Um, Wealth creation is boring. There I've clearly explained this whole thing about SIP and the benefits of investing through a mutual fund. Finally, you can give time for your career, family, health, community service. Remember, uh, your life holistically, if you look, the greatest wealth that you have is your health, your family, and what you do. And the greatest wealth you can generate is through your career, not through investing. So focus your time, develop yourself, personally develop in your career. Don't spend or waste time in the stock markets. Focus on yourself. Take a look at this from Wealth magazine from the ET, where some of these funds are displayed. Now, these are not recommendations from me. I'm not recommending these funds, but these funds, I'm just sharing the data, the returns that they have given. So if you see here, these large cap indexes in the last 5 years, they have given such returns, average 20%. And 3 years data, if you see again, average 15, average probably 20% returns. We saw just now, index has given 14%. Some of the stocks have given 50, 40, 30%, but not bad. A mutual fund in the last 3 years have given you an average of 20%, and some of the top funds have even given you 24%. Please, once again, these are not recommendations. Please check with your mutual fund distributor or investment advisor and then invest in these funds. I'm just sharing the historical data. Now, there are also drawbacks investing in a mutual fund. Many mutual funds don't beat the benchmark. So, although the risk is much less compared to directly investing, so some of the worst performing mutual funds would have given 11, 12, 13%, less than the benchmark, but they are not bad. They are still positive, but they are drawbacks. Nevertheless, it's a drawback that mutual funds also do not beat benchmark. Not all, a lot of them. Now, they have comparatively less returns compared to directly investing. Of course, the probability of profits are higher here in mutual funds, but you cannot get returns of 50 and 60%, obviously, because it is diversified. These are diversified mutual funds, diversified equity mutual funds. Then you have to revisit your portfolio once in a year or once in 2 years and switch if required. Obviously, if you are investing through a mutual fund distributor, your mutual fund distributor will do that, but you still have to revisit because uh, the funds may not remain top performing for always, forever. They may also fall below the benchmark. And if consistently they're below the benchmark, you need to reconsider. So that is another drawback. And of course, there are expenses and fees more than direct investing. Direct investing, you may have a little brokerage and transaction fees. Uh, but in a mutual fund, you have to pay a fee of ranging from 0.5 to 1.5% of your assets. So that's a drawback. Let me share you an article where it shows that a lot of the mutual fund, a lot of the active mutual funds have not been able to beat the benchmark. Here's an article from ET uh, in May 2024, just a couple of few months back. Unlucky 88% large cap mutual funds failed to beat benchmark in 7 years. This is what ET Mutual Fund, this is an analysis by ET Mutual Funds. There were 24 large cap schemes in the market that have completed 7 years of existence. Out of 24 large cap, 21 schemes have failed to beat their respective benchmarks in 7 years. In other words, only 3 large caps managed to outperform the respective benchmarks. And here are the funds which are given here. These are all the benchmarks, 14.33 and 14.71. Probably one is NSE and one is BSE. And these are the mutual funds which have not beaten the benchmark. Canara Robeco, SBI Blue Chip, these are the outperformers which have beaten the benchmark. Baroda, ICICI, and Nippon India. Again, these are not recommendations. Please talk to your advisor and then only invest. So, what do we do? What if we want to ensure that we are always in line with the market or above the market? Now, there are times when we invest in mutual funds, we may get less returns. But what is the guaranteed way of getting returns equal to the benchmark? Yes, there is a way out, and that is called as passive investing, which means investing in an index fund. So instead of investing in a mutual fund, an active mutual fund, you invest in an index fund, which is again distributed by mutual funds, mutual fund companies. There are indexes, they follow various indexes. They follow the Nifty 50, they follow the Nifty Next, Nifty 100, they follow BSC, Sensex, and they follow BSC 100. Then there are number of large cap indexes. Of course, there are mid cap and small cap indexes also, but there are number of large cap indexes which are mutual funds which you can invest. By investing in an index fund, you are guaranteed a return equal to the benchmark. Let me share with you a few of the mutual funds which are there following or tracking exactly the index. So here is an article, top 10 index funds in India by AUM 2024, an article by Forbes India in June 2024, just a couple of months back. And so these are the top 10 equity index funds in India, which follow one index or the other. Here is a Nifty 50 index, HDFC Index Fund Nifty 50. Again, these are the same Nifty 50, Nifty 50. And here you have the BSC Sensex 30. Here there are 50 companies. Here there are 30 companies. Next 50 index, next 50, Motilal Oswal S&P 500 index fund. And here again, the 50 index funds. So there are several index funds where you can invest. So these index funds will mirror the returns from the index, the benchmark index. So you are guaranteed getting what the market gives. So what do you do? Should you invest in active? Should you invest in passive? Now, of course, there are advantages and disadvantages. If you ask me the preference between direct investing and mutual fund investing, I would anytime choose mutual fund investing. I've been in this industry for the last 30 years, and I believe there is nothing better than a mutual fund where a professional fund manager is investing. If number of fund managers are not even able to beat the index, what about you and me? We will have to research and invest directly, but the chances of getting good returns is low. So the best way is to invest in mutual funds and mutual funds actively and also passive. So which is better, active mutual funds or passive? So the way I look at it is invest some of your money in the index funds and some of your money in an active fund, both large caps. Over a period of time, you will find that the returns are good, because if you only invest in an active mutual fund, what if that mutual fund doesn't do well in the next coming years, few years, right? You have the index fund which will do well. And if the active fund also does well, great. But what if you only invest in an active fund and if it doesn't do well, then what? Yes, it may not give you less returns. Definitely, it'll give you more than 10%, because even the worst of mutual funds give you good returns. But if you also have an index fund, The combination will give you guaranteed good returns over a long period of time, above 5 years. So if your risk profile is very low, conservative, go for index funds. If your risk profile is moderate, then go for 50-50 index funds and active funds. If your risk profile is aggressive, so you may say, oh, I don't want to invest in large caps. I'll only invest in mid cap and small caps. But my strong recommendation to you is have a small portion of your portfolio in large caps. That will keep your portfolio stable. It will not go too up and too down, especially when you want to redeem it before your financial goals. If you have everything in mid cap and small caps, and if the markets are crashing or down, you do not get the best of your returns. But if you have a portion, a 10-20% of large caps, and the rest of your equities can be mid and small caps, this 20-30% will give you that stability. So as always, let me summarize what we have done, just to recollect so that we can make the best use of this knowledge. We first saw why equity should be a part of our portfolio because of the phenomenal returns that equities have given in the last 20-30 years compared to all other asset classes like gold or debt or real estate or bonds, etc. Then we understood what are large cap equities. What do they mean? Basically, large caps are the top 100 companies in the index, which have market capitalization more than 20,000 crores. Then we saw some examples of large cap like Reliance Industries, how a market capitalization is calculated, and what does it mean when we say that these are the top 100. Then we talked about the 5 things about large caps that makes it preferred in a portfolio. The 5 things, let's recollect. The number one, they are the blue chip stability that they give. So number two, they give high returns, but with less risk compared to the other categories like mid caps and small caps. They give regular dividends. Number four, they are market leaders. And number five, they have global reach. And investing in large cap stocks gives you an access to some of the best companies in India. Then we talked about how to invest. Should we invest directly or through mutual funds? Right? And the challenges and the benefits and challenges of investing directly, especially those with high risk profile can consider directly investing. But there are challenges, there are negatives, there are challenges. We saw that there are some stocks which have given even negative returns in the last 3 years. Mutual funds are the most preferred ways. Even somebody with low profile, low risk profile, moderate risk profile, or high risk profile can buy mutual funds. They have their own benefits and challenges. And finally, we saw the active versus passive mutual funds, the index funds, and combination of both active and passive will give us the required good returns from large cap companies. So we come to an end in this video. We have covered some of the very good things. I personally enjoyed researching and finding out about large cap equities, large cap companies, mutual funds, index funds. So as I emphasized right in the beginning, you must have a large cap companies in your portfolio. Even whatever is your risk profile, you must have, because equities are the engine for the growth of your portfolio, and large caps will give you that stability in your portfolio. So what do you think about this video? Please let me know in the comment box. If you got bored with this video, the way I've taught it, please let me know. Or if you've enjoyed it, if it has added value to you, please let me know. And this is my hope and desire that you will take action. You will take action and invest. Watch my other videos where I've talked about mutual funds, how to invest, and um, asset allocation, etc. in the last previous videos. And this is a follow-up to my asset allocation videos. This is the third in the series of large caps. The next video, I'll try and cover the mid caps and then the small caps and then flexi caps and then hybrid funds and bond funds, etc. So that we can take very informed decisions and have some of the best funds in our portfolio. Thank you for hearing me till the end, being in this video till the end. If you have liked this video, please share a thumbs up. If you have not subscribed to this channel, I encourage you to subscribe to this channel and be a part of this journey of growing your wealth and your relationship. Thank you. See you soon.